Good morning, good morning, good morning, and good morning, good morning, good morning. Hello, hello, hello. I think I'm starting to say things like really, really repetitively. Really, really repetitively. Really, really repetitively. All right, cool. So let's just jump into things. So what I wanted to do, actually, I guess we can rewind a little bit. So first of all, tomorrow's the 4th of July, which means today is a half day for the market. I have a question over there. Hey, good afternoon. Andrew, type in the chat box. Silly goose. Okay. But Andrew, good afternoon. So this week is 4th of July, and Andrew might not be too happy about it because he's from the UK, and this is where we celebrate kicking y'all's butt. So I don't think he's going to be celebrating tomorrow, but that's okay. I get it. So today's a half day for the markets. I believe they close at 12. And then tomorrow the market is closed. And then the rest of the week is another slow week, right? 3 days and then 2 days off. And then next week, you kind of start getting back into stuff. What that means is the volume is fairly low. Now, why is that the case? Well, the majority of money that's managed on Wall Street are managed by really high net worth individuals, right? So, mom and pop, you and me, our stock trading might not be so revolving around 4th of July because it doesn't matter to us. I bought 100 shares of Microsoft the other day. I'm really watching it. But the individuals that run the pension funds and the mutual funds and those funds, they make so much money. And God bless. No one's saying, well, I guess they shouldn't make that. Whatever. They make a lot of money. But during these months, during these times, they go to the Hamptons, they go to all these fancy places, they bring their family, they get their big yachts, yada yada yada. In doing so, they don't leave a level of risk back at the office. For instance, no head of a pension fund or head of a hedge fund has a whole bunch of positions on while he's shutting his phone off and spending time with his family because his wife and his family would say, Dad, 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 like spend time with us, get off the phone, you're always working. In which case, these individuals know that they've been afforded a certain lifestyle and that if they want to keep it, there's certain sacrifices that go with it. Now, that decision's kind of taken out of their hands because they all kind of do it together, right? Like you couldn't be a hedge fund manager and say, okay, you know what, during these months, I'm just going to work my tail off. Well, all the other hedge fund managers have agreed, and not on paper, right? But like just the culture that they're not going to be doing that. And if they're not doing it, it means all of their money isn't transacting. And if their money's not transacting, the volume is low because the transactions equal the volume, right? The volume is how many transactions. Now, what does volume mean? Well, we know what volume means. I just defined it. So it was a silly question, sorry. But what does low volume mean to a market? What is the risk of that? Well, the risk of having low volume is that you have high volatility, right? So say for instance you have 1,000, say your volume is 1,000, right? And somebody sells 10. Well, what is that? They sold 1%. So realistically, if you have 1,000 of something and 10 are sold, that thing would go down 1%, right? Because you sold 1% of it. Okay. Now let's say the volume is a million and somebody sells 10. Well, what percentage is of 10 of a million? I don't know, probably 0.00001, right? Like some number like that, meaning the volatility now, that asset goes down that percentage, that minuscule percentage. Now let's say the volume is 100 and someone sells 10. Well, 10 is 10% of 100, meaning that asset will go down 10%. The point being, nothing has changed. Someone's selling 10, but the results are so drastically different because the volatility increases when the volume decreases. So during these months, and especially during weeks like this week, where you have Friday and Saturday were just yesterday, right? Like that just happened. No, Saturday and Sunday. And now today we have a half day, then tomorrow we're off, and then we have 3 days, and then we have another 2 days off. Do you think any mutual fund, any hedge fund manager worth their salt is sitting there saying, yeah, family, I'm not going to spend these 7 days with you because I have to really be working. Yeah, sorry, wife. I know you've caught me doing a bazillion things and all of this money has corrupted my lifestyle incredibly, but you've allowed it. and you've stuck by me, but I'm not even going to give you this week. Like that's the kind of the trade-off. The point of all this is that during this week, a lot of volatility, a lot of unexpected things could happen because you don't have the volume to decrease the volatility. So say for instance, some unexpected event happens, right? Like some bank goes under or something happens. Cushion, thank you, Deborah. Something happens. Well, the market is not in a position that it can go ahead and withstand that blow. It would take a very, very large move. I'm not predicting it, but say something bad happens, you could see a market go down 5,000 points that day because there's no volume to go ahead and support it. Conversely, if something good happens, you could see a market go up a lot because there's not enough volume to sell against it, which means the professionals do not trade during this time period. Because the professionals, like we shared the other day, they're not in the market to make 100%. The real people don't do that. When I was on Wall Street, I had a client, and it was at the beginning of my days, and I bought him a stock option, and it went up 40% overnight. Like the things that you and I would jump up and down about. And I thought I was like 21 years old. I was like, yeah, Mr. Jones, I'm so great, blah, 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 blah. And he screamed at me like you wouldn't believe. Like he fired me. And his words were, I don't need you to make me money. I've been working my ASS off my entire life. I need you to protect my money. And if I get lucky, maybe a little bit of return on it. But for you to make me 40%, do you know the level of risk you took with my hard-earned money? You could have very easily been down 40%. And that stuck with me. And what you realize about these individuals is the way Wall Street gets paid. They get paid percentage of assets and percentage of profits. Now, you might think to yourself, well, Ant, percentage of profits, like, isn't that what we're talking about? Don't they want to make 100, 200, 300%? Well, ideally, sure, why not? Like, who doesn't want that? But what does it take to do that? You have to take on such a level of risk. And taking on a level of risk means things aren't always going to go right? Like risk means you don't know the outcome. You're risking the outcome. So if you take on a level of risk to make 100%, well, if it was so easy, everyone would do it. So how much risk are you taking? Well, maybe you're tolerating a risk level that, somebody else wouldn't tolerate. And that's how you did it. Eventually, what happens is you blow yourself up. Now, when you're in Wall Street and you're a money manager and you blow yourself up, do you know what people don't want? To work with you. Oh, you're the guy that all of your clients went to zero, right? Oh, you're that. Oh, but you made them 100% before, but you're a complete cowboy and you destroyed all of these people. Yeah, I have no interest in you. Zero. But I can make you 50%. I know how to do it. I learned from my... No, go away. Get out of here. Nobody wants to work with that person. You know what person they do want to work with? And again, you'll see this DNA in Rhino. Remember when we talk about how Rhino is predictable and stable and non-volatile and it just allows you to trust and it goes up slowly? That wasn't because I just woke up one morning and thought that. I've seen it. I know how this business works. You know who the people they do want to work with? All right, what did the S&P do last year? The S&P 500, which we shared the other day, it's the 500 largest companies in the world. I'm not asking that question to you. I'm asking it rhetorically because I don't know what it did. Let's say it did 10%, right? Okay, the S&P 500 did 10%, which means I, as a complete do-to-do that knows nothing about nothing, could have bought the S&P 500 because there's a stock index ETF. Anyone could buy it. It's SPY. And now you own a small percentage of that entire 500 companies in the world, which means that ETF, if the S&P went up 10%, that ETF probably went up 9.95%, right? Because again, there's a management fee, so they take that. Okay, so the S&P went up 10%. Well, why should I work with you? Well, my investors were up 12%. Well, that doesn't really sound like that much. It's 2%. Yeah, it's 2%, but in fact, I've outperformed the S&P for 10 years in a row now. In fact, for 10 years in a row, my performance is better than the S&P. And when you compound that, if you invested in the S&P 10 years ago, you would have, let's say, $100. But if you invested with me 10 years ago, you'd have $150. Does that make you a little bit more excited? Well, actually, it does. That's pretty cool. Why would I be there if you can easily do this? But what's it going to cost me for you to take my money? Like, what's your management fee? Oh, don't worry about it. It's not that much. In fact, I do, let's see, 1% of assets and I don't know, 5% of profits. Okay. So the 12% you did last year, what does that really come out to? Well, 1%, now I'm at 11, 5% of profits. Now I'm kind of at like 1095. Yeah, you are. Okay. Was 1095 higher than 10? Yeah. So by simply bringing your money to me, you're going to outperform the S&P. You're going to make more money. Even despite the fees, you will make more money. Why wouldn't you? Well, duh. Why wouldn't I, right? So here's my money. What just happened? The portfolio manager, because he does not take those type of risks and he can show a consistent level of return that outperforms the S&P, just came into new assets. Now, how hard of a sale was that? It wasn't hard at all. It was very common sense. Well, if the sale wasn't that hard and it was very common sense, then how much assets can he bring in? Probably a lot. So the mutual funds and the hedge funds and the pension funds have feeder funds. That's what they call them. And they hire these individuals and say, listen, go find me assets, bring them in, and I'll give you a percentage of it. I just need the assets. Bring them in, bring them in, bring them in, bring them in. Okay, cool. So they bring it. It's kind of like Facebook marketing, right? If you think about it, they're paying a little bit of money to bring a whole bunch of people in. Okay, great. So they do that. So you remember that whole 1%, they get a 1% management fee? That doesn't sound like a lot. 1%, 1%, right? Well, what's their assets under management? Because 1%, you need to know it's a percent of something. What's that something? Oh, their assets, it's like 15 billion. Oh, wait a second. $15 billion is what they manage? 1% of that's $150 million. This guy's getting paid $150 million to outperform the S&P by 2%? Does that sound like it? Does, well, Anthony, that's the way the business is. What they're doing doesn't it's like a plane. It's like a movie theater. It doesn't matter how many people are on the plane or in the movie theater. The overhead's exactly the same. These individuals do their work to produce a return. The money that comes in does not change the level of work they do. It just means more people are benefiting or not benefiting from that work. The point of all this is when you talk about what the real money does, they have no interest in weeks like this. Zero. They close their books and they say, you guys, Cowboys, you guys go do it. All I want is I own my Apple, I own my Google. I got lucky with Tesla. Let's see, it's now July. The S&P is up 5%. I'm already up 8%. Maybe I'll sell everything, buy just the S&P, and I'll cruise into the end of this year up 3%. Now, of course, they couldn't actually. I bet you some actually do that. You wouldn't want your clients knowing that because then you would kind of be like showing them. But I bet you a lot of them sell a bunch of stuff and then just buy bonds. They're like, I'm not taking any risk. I'm gonna end this year up 3%, and I'll raise a whole bunch of more money, and my salary next year will be 200 million. That's the way Wall Street works. So I share this with you because I want you to understand what, not only to have a context of this week, but again, what are we getting into? What does the real money want to do? When somebody says they can make you 100%, they are the person that nobody wants. In fact, everyone doesn't like them because the level of risk that they take. So let's kind of jump into some, well, actually, before we do that, the goal of this week on my behalf, and of course, if anyone wants to help me, that would be really, really helpful. I want to back test that 4-hour bar algorithm for the last year, which means I need to go ahead and pull up a chart of every single stock on the S&P, pull out for an entire year using 4-hour bars, and identify every time there was a count, was there red and green, and how did it resolve? The point being that's probably going to take like 15 hours. But if I can back test this strategy that we're identifying right now over the course of last year, well, then I'm going to feel quite confident that we can act on it. And the beauty of that, if we can act on it, our new approach is yielding us 2 to 3 opportunities per week. Our former approach, which we're not trading, it's not like we threw it away, yields us 1 to 2 opportunities a month, meaning we could have anywhere from 11 to about like 17 opportunities a month. There's only 20 trading days in a month, right? So if we're able to have let's say 15 opportunities in a month that we feel a 90% certainty that we can make 40% over the course of the next 1 to 5 days, well, you could turn $100 into 140 into, and just keep compounding 40% on it, which means, and this is not something I'm just saying because it's like, oh, I'm speaking to our audience. We're already in Rhino. I'm not telling anyone to get into Rhino, right? So I don't want this sentence going off like I'm still selling. You're here. But can we go ahead and market performance that last month we started with $300 and we ended the month with $15,000? Like, can we do something like that? And if we can we do that 3 months, 4 months, 5 months in a row? Now, of course, you might be thinking, well, Ant, you just told us a whole story about how people like you, like nobody wants to work with. Yeah, I know. But this isn't buying and selling stocks. This is stock options. The difference being that same stock that went up, say, 2%, if you had purchased an option on that stock before that 2% move over a short duration, like 2, 3, 4 weeks, that option would have been up like 40%. Now, the only difference is the stock, if it doesn't go up 2%, you still own the stock. The option, if the stock doesn't go up 2%, goes to zero. Like, that's the difference in risk. But if you back test enough, you understand your parameters, you right size it, right? Like you make sure the risk reward is where you want it to be, and you have levers. What I mean by that is, okay, so say for instance, we're going to get into this investment for 4 weeks. Now we're only looking to be in it for like 3 days, right? But we'll buy something 4 weeks out because that's how we cushion ourselves. All right, well, if we don't get what we're looking for this week, let's get out of it, because we could surely sell it to someone else because they'll take the risk that there's still 3 weeks to work. Meaning, I don't think if you're disciplined enough to always sell an option with still 3 weeks to go, you'll ever lose more than 50%, 60%, because you might be down 30, 40%, right? Which is not good. But since we know, okay, if this stock hits this count with this red and green, then for us to have that 90% positive performance, it must exude the following characteristics. This next bar must look like this, right? Because of course the next bar must be going up. Well, if the next bar is not going up, what do? Do we sit there and say, oh man, well, there's 20 red and green. Maybe it's turning into a 21 red and green. Who knows? And probably we'll probably stick in it. But now it's a 22 red and green, which means we've been wrong for 2 bars in a row. Is it still red and green though? Yeah. So you have to ask yourself, what's the level where you would say you're unwilling to risk that high of a count to red and green? Because for those that have been in RHINOwealth for a long time, last year we had a stock that we lost so much. I lost 98% of my money in one stock, which is probably not good to say, but life happens. Why did that happen? Intercontinental Exchange, which was a commodity exchange, 20 red and green, 21 red and green, 22 red and green, 23 red and green, 24 red and green, 25 red and green. And I was like, I'm disgusted at how much money I'm losing. But it's still like, this might be the opportunity of a lifetime. Like, look where it is. And I put more money in it, which is wrong. You don't put good money in after bad. I looked at the earnings. I looked at everything. Everything was so strong. There was no reason for this company to not be doing the best it's ever had. And it was. The company was doing the best it ever had. So how did I lose money? The company was doing so good that they bought another company. You know what happens when you buy another company? Do you know how much money it costs to buy another company? When you take all of that money off your balance sheets to buy a company, your stock gets cratered. It went down like 10% because now you're taking on a billions and billions worth of debt and who knows what happens in the future. You're paying someone else. So what happened was the red and green, what they identify is still money flow going in, coiled spring approach, all of that stuff. The count still goes ahead and shows you that it's moving lower. So all of those things together are good indicator. When you still see money coming in and you still see, are all good indicators that it's not a company problem, it's a stock problem. Like the stock is just moving lower and it will rebound unless the company's going to buy another company. And that's a problem. So we got, well, I say we, again, I'm not a financial advisor. I got annihilated. Anyone else that owned it shared that same annihilation with me. In theory, right? No one told me about it because I'm not anyone's advisor. But the point being, at what point would we say, no, this has just gone too far? And I would say probably 24, 25, I would say something's not right. This should have rebounded. And now here's the pro and con of that. Why would you not want to get out of a 25 red and green? Well, because Anthony, that's like super coiled. That's like ready to go. Yeah, it is. So the risk is that I missed that, right? That's the risk we're talking about. Okay, so what's the reward? Well, if this thing's so strong that it buys another company or something we didn't know, like say for instance, the CEO is getting subpoenaed to court because he got caught diddling kids. Do you think that's going to be common knowledge? No, it's a court hearing. So the stock would be going down because probably someone knows something and they're just selling it. Maybe it's insiders, so they're selling it. The stock's going down. But everyone else on Wall Street's like, how is this company going down? Look how great it is. This is the opportunity of a lifetime. So they're putting money in. So the red and green is strong. The count is increasing, but the stock's going down. But why? And then you find out the headline that the CEO just got indicted for like diddling little kids. And you're like, oh, duh. That went ahead and described what I'm seeing. The point being, when it gets to 24, 25, more times than not, something's not right. And I learned that the hard way with that. So what I'm sharing with you in very colorful language, because you got me into Wall Street speak. I got to tell you, so Anthony's Rhino. But when Anthony was on Wall Street, there's certain ways you talk to certain people when you're in certain environments. And it's a comment, yeah, I bought this company and CEO is diddling kids. Like, could you believe it? It's just, I don't know. They're creepy people. But the point being, so if you purchase a stock option 4 weeks out and you know to yourself it's already 20 because you're buying it 20 red and green, and you know your risk tolerance is to 25, then 20 to 25 is 5 bars. So if it's a daily chart that you're looking at, that means your total risk is I'm going to sell this at the end of this week, win or lose. And I still have 3 weeks on it, so maybe somebody else will buy it for me and I won't lose too much money. Like maybe I'll lose 30 or 40%, right? Which doesn't sound good, but it's good to know your risk. Maybe you'll say, Anthony, I don't buy until 22. Maybe you say, Anthony, I sell at 23. I don't know. That's not my business to know, right? So you can go ahead and effectively manage your risk the way you want it to. The point of what we're doing is we're trying to make the tools so that everyone can manage their risk. Managing risk is not something where you just walk outside and say, okay, today I only want to go down 10%, but I'm willing to take 20% up. Great. What do you think? God comes down and says, well, Deborah, you are a really holy person and you're absolutely fantastic and everyone loves you. So since you said that, I'll make it so. That doesn't happen. You have to be able to identify how to actually make those parameters in place. So what we're going to do is if we can go ahead and back test the 4-hour chart to see that when it gets to this count, on average, this many bars equals this percentage. And the way we're doing it is how many bars after the count, so 18 red and green or whatnot, before the first bar is negative. Because what we're trying to produce, and this is the end result that I want, right? I want to say to you, sorry, my back. Over the course of the last year, we have back tested every company in the S&P 500 on a 4-hour chart. What we have come to find is that stocks that exhibit an 18 red and green with a 92% probability will then increase the following 3 bars before they experience their first down bar. Those 3 bars on average will produce an increase of 2.75% in the stock. If I can say that sentence then we know there's a lot of data behind it, right? It was back tested by the entire world of stocks for an entire year, right? Like, so we're comfortable in the data. Okay. So then if we know that, and that's what I love about this group, right? That sentence I just said is worth easily $1 trillion. But we don't know that because we're all getting new to it. And that's fine. That's what makes me so excited. Because if I can then say to you, okay, great, guys, we have an 18 red and green. It produced itself today. It's ABC stock. And what I'm going to do is it's a $100 stock, 2.75% equals $2.75. It's currently $100. I'm going to buy 4 weeks out ABC $102 call options. Right now, they're going for, I don't know, $2. And regardless of the price of those call options, I'm selling it, let's say 3 bars. 3 bars times 4 hours is 12 hours. 12 hours takes over 2 days, right? Because there's 9 hours in a stock day, meaning you have one 4-hour bar, and then you have a second 4-hour bar. Is there 9 hours? So 9:30 to 4. So it's 6.5 hours. I'm sorry. So you have one 4-hour bar, then you have a second 4-hour bar. So the third 4-hour bar would be the next day. So if you believe that if on average those 3 next bars are up, then you could say to yourself, well, if I buy this today at 9:30 when the market opens, then 3 bars later will be tomorrow. Let's see, 10:30, 11:30, 12:30. It will be tomorrow 1:30. In which case, I'm putting my sell order in that tomorrow. So the way that actually works, and not to, pollute the situation. So when you're selling something, you have a limit price. So if a stock is $100, you could put in a limit to sell it at 101, meaning if it gets to 101, it sells. You can put in a limit to sell it at 1,000 with the complete notion that you don't believe it's ever going to get to 1,000. But because that order's in, what you can do is that at any point while that order's in, you can just press the button and go market order, which means it sells it at the market that second. The point of me saying that is I can go ahead and buy a stock today at 9:30 and know that 3 bars from now will be tomorrow 1:30. So I'll put in a limit order to sell that a bazillion. And then tomorrow 1:30, I'm going to come back to my computer, see where it is, win, lose, draw. I don't know. We'll see what happens. And I'm pressing that button for market order. And I'm going to get my money. But if I'm able to say with a 92% probability that 92% of the time, that number that I sell is going to be higher than the number I bought, and I could have this opportunity 2, 3, 4 times a week, well, then what are we really talking about here? That's the key. So what I intend to do this week is to do the back data on all of that and have those results by the end of the week. We have 1 minute left, so I do want to show you something. And I see that there's a Q&A, so I'm going to jump in there for a second. But where is it? Come on. Trading view. Okay, cool. This is what we're looking for. Let me just move this around. La, la, la. So what you'll find in the RHINOWealth doc that we have, I already started building out the page. So if you go to the 4 hours, let me just give this to everyone just in case, right? Everyone should have it. It's in your emails. It's in your emails every day. It will always be in your emails every day. But yeah, there it is too. So when you go, you'll see that the work that we did last week was these stocks. I put them always at the bottom so that there's no, we don't need to see them. And we could see Capital One, which is COF, when it was an 11 red and green, it went up the next 3 bars for 3.87%. You might say to yourself, well, yeah, 11 red and green. I can find 11 red and greens all day. That's the best thing ever. Okay, great. But now let's take a look. 11 red and green, that's the average percent. That's the average bars. That's the occurrences. What was the percent success? 12.5%. Are you interested in 12.5% success? I'm not. And how did I get that? Well, because of all of these occurrences, you can't have a 12 unless your 11 was unsuccessful. You can't have a 14 unless your 11, your 12, and your 13 was unsuccessful, right? To get to the next number, the previous ones had to have been unsuccessful. So if we go ahead and follow all the data, what we can say is 19 red and green, we had 1 occurrence and it was 100% success. 18 red and green, we had 2 occurrences, but 1 went to a 19. So 87.5% success. Now, this was only over the course of 6, 7 stocks over 1 week. What if I backtest the entire S&P 500 over the last year? We're going to have, I don't know, probably like 1,000 stocks. If we have 1,000 stocks, would you be able to trust these numbers? Would you be able to trust these numbers? Could you then act on those numbers? Is that enough data to act on that number? For me, it is. Now, whether it works out well or not is a whole different ballgame. And then once you're in it, you're able to say, okay, I know my parameters. I know what I'm looking for. I know what I'm expecting. Let me make sure it all goes well. It's like when you go on a date with someone. Okay, I spoke to her online, right? Like we conversed. She said she was 5'5", blonde hair, blue eyes. Okay. When I walk into the date, guess what? I'm expecting a girl 5'5" with blue eyes. If the girl says, oh, hey, and she's a redhead with black eyes, well, guess what? I don't need to be on that date any longer. I know that something's not right. So I can sell the date right there. I'll take my loss. I paid for the cab. I bought her a coffee, even though she was redhead with black eyes, which is completely freaky in my head. And anyone that knows me knows, okay, is Anthony thinking about date? No, I'm not. I'm actually the opposite. I'm thinking like, stay away from me. But the point being, if you know everything you're expecting and you're able to handicap that, well, then you should be able to identify when something's going right or not going right. Because if you do walk into that date and the girl is 5'5" with blue eyes, you can sit down and you can say, okay, this met my expectations. Well, I spoke to her last week and she said she loved the Yankees. Now there's a baseball game on and the Boston Red Sox are on and she's jumping up and down because they're winning. Well, now we know that's something's not right. She said she was a Yankee fan, but she's now rooting for their arch nemesis. I wasn't expecting that. Let me get out of this right away. But if the game is the Yankees and she's rooting for them, okay, she's 5'5", blonde hair, blue eyes, rooting for the Yankees. It's everything I was expecting. You could stay in it. The point being, the more times you do this, you start developing that algorithm a little bit more tighter, more filtered to the real world. And if we can go ahead and start taking action next week and further tighten it to increase our percentage, then I'm happier than a pig in SHIT, right? Like, oh my God, I'm speaking so Wall Street. And I'm still spelling it out, and I still think I sound, we'll be happier than a boy with a cake, right? Like, that's the goal. So I don't even need to look at the market. I think it's closing in a half hour. I will start working on that data. What I meant earlier in the call saying if you guys are willing to help, that would be cool. Everyone has the algorithm. If you don't have the algorithm, upload the algorithm. If you haven't uploaded the algorithm or you're unable to upload the algorithm, email me. I'll work with you to do so. Because, and I'm sharing screen again, because if you have that accomplished, well, then what you can do is go to your charts, right? And say, okay, I want to pitch in a little bit. All right, let me move this to the 4 hours. Okay. Let me go ahead and, so I did this myself. I put the S&P 500 companies. It took some work. I was actually able to upload it because I'm not a premium member, but it's like $6 and it allows you to upload a whole list. So I can go ahead and say, okay, Microsoft, right? Now, also what I can do is then I'll take this chart and look at this. I'm moving it all the ways back. Now, how far back are we? This is November 2021. We're in 2020. Okay, so this has been more than a year. Okay, so I'm looking at Microsoft. All right, here we are, Microsoft. But I want to, so let's see, right over here, do we see any greens and reds? Over here, there's a 17. So I pressed the magnifying glass and now I'm pressing 17. I thought I was doing something. Okay, apparently, oh, that's why. Okay, so when you press the magnet, it's now going to make a box for you. So I make the box and then I press enter. And it zooms me into that spot. And what I can see is, okay, Microsoft was 17, red and green. Okay. I go into this box and I can see price range. So let me take the bottom and go to the top. And what can I conclude? All right. When Microsoft was 17, red and green, 1, 2, 3, 4, 5 bars. Before we had a down bar, right? 5 bars. Well, actually, this one's a down bar. Oh, that's kind of obnoxious because you don't want to like, you need to make sure your data is correct. You can't be objective with your data. No, you can't be subjective. It's supposed to be objective. Oh, that's really annoying. All right, let's pretend that didn't happen, right? Okay, so 5 bars later, and it's up 6.38%. So what do? Okay, so I take that data, I go over here and I say, I put it down here, because this is our raw data, and then we'll take this and move this back up here. Now, of course, this is in read-only for you, so you can't actually press those buttons. But you could go ahead and make your own sheet or take your own notes and send it over to me, in which case I will use your data. Okay, so great, that happens. Now let's get out of there. Has it happened any other time? I don't know, let's look. Well, this has a red, so let's see what number that is. All right, so this was a 14 red and green. No, 13 red and green. Wow, 13 red and green, and look what happened. It went from here all the ways to, come on, all the ways to here. So 1, 2, 3, 4, 5, 6, 7, 8. Those are 8 up bars. So at 13 red and green, it had 8 up bars for a total of 6.18%, right? Now, of course, what just happened? And I know I'm going over, so I'm going to just stop it here. Well, after I say this sentence, what happened? Well, 17 red and green did well, but so did 13 red and green. Okay. So isn't that conflictual, right? Like if you act on 13 red and greens, and yet there's 17 red and greens, well then to go from 13 to 17 means you're going to be wrong 4 bars in a row. So I wouldn't want that. Well, that's the point. Let's see how many of these occurrences happen. Because if we're able to prove 13 red and green has only a 55% accuracy, well, are we going to invest in those? No. It's great to see that some work out. Of course, some are going to work out. But that doesn't mean we're going to get in all of them. And what it seems like is 17, 18, 19. We haven't seen a 20 yet, so we're going to look for them. But you were able to see how quickly I was able to do that, right? So I'm going to do that over all 500. So it's going to take a lot of time. But now you have the power to do it as well. If you want to do your own research, God bless. We'd be delighted for that, right? Like Rhino has always been all of us together. I'll always charge and steward. But if somebody, shares, like I'm the happiest person in the world. So let me see. I have 2 Q&A. Not sure if it would be time effective for you, but could you put together a how-to in relation to reviewing the? Okay. Well, I love Andrew. Sometimes I just answer questions, right? So I think what I just did probably answers that. But to Andrew's point, I'm going to go ahead and actually like edit that and make it look a little better and give it some direction. So that's that. So let me go. Love you all. Don't know where the market is. We're not in anything. This is purely a research week. Next week, let's go ahead and make some moves. I said let's again. It's not. I don't care what you do, right? Like I'm going to have $300 in my account Monday, and I am looking to buy something at some point next week. And I'm going to hit my hand until it falls off. So love y'all. Oh, my pleasure, Andrew. Have fun. Happy 4th of July, even to our friends in UK, where we kicked your butts and took your tea and threw it off a boat. And that's that. Love you. Bye.